Remember our dragon? Well, after burning down half the forest, he accidentally left you a parting gift. Hidden beneath the ashes, you find a phoenix. Congratulations. You somehow traded one financial headache for an entirely different one. Because dragons are expensive. Phoenixes completely confuse accountants. Today, we're going to answer one simple question. What's the economics of owning a phoenix? Step 1. You already know this part. By now, you know exactly what happens next. You try to figure out what it's worth and discover there's nothing to compare it to. No second phoenix. No phoenix price index. But we've been here twice already. With the dragon, only 15 existed. With the unicorn, there was exactly one. Both times the same rule applied: scarcity. When something is nearly impossible to replace, people will pay extraordinary prices for it. So the offers arrive right on schedule. $20 million, $50 million, $100 million. Not because the phoenix earns anything. Not because it produces anything. In fact, it hasn't done anything at all. It's just sitting on a branch, occasionally glowing. But scarcity is the part we've already covered. What makes the phoenix genuinely different doesn't show up until your accountant does. Step 2. Your accountant is having a bad day. A week later, your accountant arrives to prepare the annual financial statements. He looks at the phoenix, looks at his laptop, looks back at the phoenix, then asks the question every accountant asks. So, how long will this last? Normally, that's easy. A company car might last 10 years, a warehouse, perhaps 50. Every asset has a useful life because eventually everything wears out. And because things wear out, businesses record depreciation. Buy a machine for $1 million, use it for 10 years, and you book $100,000 a year instead of $1 million at once. Simple. Predictable. Then he looks at the phoenix. So, how long does this one live? You smile. Forever. Right? But eventually it dies? Technically. So, we depreciate it? Well, it's about that. Every few hundred years it bursts into flames, turns to ashes, and comes back minutes later as a young bird. The accountant stares at you. So it resets? Exactly. He slowly closes his laptop. I don't believe accounting standards ever considered this scenario. And he has a point. Depreciation assumes one thing. Assets get older. The phoenix does the exact opposite. Every time it dies, it becomes brand new. No repairs, no replacement, no upgrades. Just a very dramatic factory reset. If an asset never gets old, does it ever really lose value? Step 3. Book value versus market value. Your accountant isn't ready to give up just yet. He opens another textbook, then another one. 3 hours later, he quietly admits something. I have absolutely no idea. And that's because there are two very different ways to value an asset: book value and market value. Book value is what accountants think something is worth after recording depreciation year after year. It's based on rules, spreadsheets, and far too much coffee. Market value is whatever someone is willing to pay today. Usually those two are fairly close. A delivery truck worth $80,000 won't suddenly sell for $8 million. But a Phoenix isn't a delivery truck. On paper, your accountant reduces its value every single year. In reality, nothing is being used up. The bird that comes out of the ashes is exactly as capable as the one that went in. So the write-down happens in the spreadsheet and nowhere else. Which is the real lesson? The value of an asset doesn't live inside the accounting rules. It lives inside the market. Step 4. The Phoenix finally gets a job. Of course, owning a $100 million bird is nice, but eventually your accountant asks another reasonable question. So, is this thing ever going to make money? Unlike the unicorn, you're not building a global brand, and you're definitely not renting it out for birthday parties. The Phoenix has a much stranger business model. Scientists pay millions to study it. Museums pay enormous exhibition fees. Its shed feathers become priceless collector's items. and its tears are rumored to have healing properties, which makes pharmaceutical companies very interested. 4 completely different income streams. That's diversification, or in this case, not putting all your feathers in one basket. So, let's run the numbers. Your Phoenix generates around $40 million a year. Now subtract what it costs to run. Staff, security, facilities, insurance, which took the underwriters about a year to price. Roughly $12 million. That leaves $28 million, and this is where we meet the number investors care about most. EBITDA, earnings before interest, taxes, depreciation, and amortization, which really just means one thing. How much cash does the business actually throw off? Before the accountants and the tax office get involved? $28 million. Solid, but not extraordinary. Plenty of ordinary companies do that. Step 5, the line that never gets subtracted. But there's a second number. EBIT, earnings before interest and taxes. Same as EBITDA, with one difference. You subtract depreciation and amortization. Depreciation is for things you can touch. Machines, trucks, buildings. Amortization is the same idea for things you can't. Patents, software, licenses. A van wears out, a patent runs out. And that one line is where most businesses quietly lose a fortune. Imagine a factory with the exact same numbers. 40 million in revenue, 12 million in costs, 28 million EBITDA. But that factory has machines that wear out. Say 12 million of depreciation a year, so its EBIT drops to 16 million. Now you're Phoenix. Depreciation and amortization, 0. Which means EBIT, 28 million. Identical EBITDA. Completely different reality, because depreciation is really a warning. The business quietly telling you, one day you'll have to buy all of this again. That factory owner isn't earning 28 million. He's earning 16 and setting 12 aside for the day the machines die. Your Phoenix never sends that bill. It rebuilds itself for free. This is why investors pay far more for businesses with almost no depreciation. Software, brands, licensing. They earn money without constantly rebuying the thing that earns it. Meanwhile, airlines and shipping companies post enormous EBITDA and still struggle. The equipment always needs replacing. Your accountant looks up from his spreadsheet. I've never said this before, but I think I actually like this bird. Step 6. Time becomes your greatest advantage. Then something remarkable happens. 10 years pass, your Phoenix looks exactly the same. 50 years pass, still the same. 100 years later, your grandchildren inherit the business. The Phoenix greets them. As if it's Tuesday. Most valuable assets slowly become obsolete. Factories need replacing. Technology becomes outdated. Buildings require expensive renovations. Cars lose value the moment you drive them home. The Phoenix simply keeps coming back. That introduces one of the most overlooked concepts in investing. Time horizon. Many investors spend their lives chasing quick returns. They think in months, maybe years. The best investors often think differently. They think in decades, sometimes generations, and there's a reason that pays. Imagine an asset earning $1 million a year for 20 years. Today, that's worth roughly $12 million. Now imagine the exact same asset, earning that same million forever. Suddenly it's worth $20 million. Same annual income. Nothing changed about the asset. The only difference is how long it keeps going. That's the entire Phoenix advantage in one number. Then the Phoenix bursts into flames. The accountant sighs. Never mind. A few minutes later, the Phoenix is back, young again. The accountant quietly closes his laptop. I'm taking the rest of the day off. Final step. So, was it actually worth it? Let's bring everything together. The dragon barely broke even, and one bad day put the whole thing underwater. The unicorn was completely different. Its value came from its brand, and people wanted to be part of the story. The Phoenix belongs in another category entirely. Not dangerous, not famous. Valuable because it refuses to wear out. Every other asset eventually asks for the money back. You buy it once, and one day you buy it again. The Phoenix never does. You pay once and it keeps working forever. Instead of asking, how long will this asset last? You're asking, will my great-great-grandchildren still own it? So, was owning a Phoenix actually a good investment? Surprisingly, yes. Not because it earned the most or cost the least, but because it solved the one problem every investor faces: time. Your dragon made you think about risk. Your unicorn taught you about brand value. Your Phoenix teaches something different. Sometimes, the best investment isn't the one that grows the fastest. It's the one that never stops creating value, even if it occasionally catches fire. If you enjoyed this completely reasonable financial analysis of Phoenix ownership, hit the like button and subscribe. It lasts a lot longer than the average investment. And let me know in the comments. Which mythical creature should we analyze next? A kraken, a vampire, or maybe a hydra? I'll see you in the next one.